All right, folks, welcome back. This is the algorithmic theory lecture and discussion for price action model 11. This is a day trading model, and it stalks 30 pips per trade. Obviously, the benefit of looking for a weekly expansion, like most of the models, we're looking for that. This one here, it targets old daily highs and lows, and this is one that's going to repeat a lot too. You can see a lot of setups form over the week with this because daily highs and lows have a lot of built-in liquidity. So if we're bullish, I like to look for previous day's highs, intra-week highs, last week's high, that type of scenario for runs on liquidity. But since we're usually below an old low and we're bullish, we're basically entering on internal range liquidity and utilizing external range liquidity to get us our hopefully profitable exit. But I kind of want to talk a little bit about how we don't need the weekly range expansion or the targets that would contribute to why we would expect the weekly range to expand bullishly or bearishly and still find setups. Okay, so again, it's not about being right. It's not about being accurate all the time. It's a matter of finding setups that allow the volatility to push market price from where you enter to where it allows you a profitable exit. And it doesn't need to go to your target. That's basically the same thing with all the models in every trading aspect. If you demand perfection, you're guaranteeing imperfection forever because you're never going to get anything except for frustrated. So I want to talk a little bit about how we can use this model and also not requiring it to be perfect. So let's assume for a moment you're sitting down at your desk and you're considering the Australian dollar and the weekly range expansion. And each one of these candles is obviously a weekly candle. At the time of this recording, it's Wednesday, June 1st, 2022. And it would be reasonable to anticipate the weekly range to maybe run up into this area here, maybe even revisit this area. Why? Because we've already taken sell side liquidity out here. Now we have taken buy side here, and we've took out sell side. So we're likely to go back into this range from high to low, and there's a small likelihood that we could get it to go to that level. So this right here would be a reasonable assumption for a draw on liquidity. This does not need to be traded to find profitability. And that's the benefit of having something like this model because it's very small in terms of its expectation for pips or points or handles, whatever you're trading. So on a daily chart, we're looking at the previous day. This is equivalent to what would be Tuesday's trading or May 31st, 2022. So I have the high basically noted there, and I'm expecting price to make a run above that. But using this area here, these relative equal highs, the gap over here, that's my draw on liquidity. Okay. Now, I did not take this trade, obviously. I have not been trading Forex for a while, since you all know that. But I want to kind of give you an idea of what may unfold and how this is not something that should plague your development. In fact, it should encourage you. The likely draw on liquidity to this level here and reaching above yesterday's high is enough to warrant a likely bullish scenario. So bias going into Wednesday's trading for Australian dollar should have been, and this is obviously with the benefit of hindsight, but I think I've earned that right to be able to talk like that, I think now. But if we go into a lower time frame chart, all right, here's June 1st trading, and we had sell side taken right here, consolidated, had sell side build up underneath there, and the market dropped down, rallied, and then rammed up above previous day's high, but notice it did not reach to that objective. It collapsed and went down below this low here. Is this a failure? No. If you go down to your 15-minute time frame, this is your bellwether chart, you can see we have the run from this low up, consolidated, created a pool of liquidity for sell side, The market drops down at midnight, creates a Judas swing, then rallies, comes back down in. Does this fair value gap and order block support price? Yes. So we have buy side here, that's obvious, here, and then we have the previous day's high, and we have that draw on liquidity that could be a longer term, higher time frame draw on liquidity. So when the market starts to rally again, this is London Open, so 2 o'clock to 5 o'clock in the morning, it rallies once more. It shows a nice energetic candle to the upside, creates a fair value gap. It drops down into consequent encouragement. That's a buy right there. You can be long there and expect the previous day's high to be ran out. Then, because you're expecting the likelihood of that higher time frame draw on liquidity where the weekly range may expand up into those relative equal highs, this is a larger, higher time frame draw on liquidity. It doesn't go to these all the time right from Jump Street. In other words, it doesn't have to go right from here, straight line up to that. That's a lot, and it's a big movement there. So it would be reasonable for it to obviously at least run above the previous day's high, which is this level here. But if it goes above previous day's high, how can we anticipate how far it can go? Well, in the simplest of terms, look at where we're at. We're at 0.7205. So 10 pips above that would be what? 0.7215. 10 pips above that would be 0.7230. So essentially about 25 pips above with increments of 10 in your scaling, and it goes up into New York Open. So we had previous day's highs taken, 25 pips above previous day's high, all on this run up into, going into New York Open, then it collapses. Is it reasonable to assume that you could be going long here, taking a partial at previous day's high, or just below it before it runs it, then 10 pips above the high, and 20 pips above the previous day's high? If you're not taking partials at any of these, you're doing yourself a disservice. You haven't applied the things that you've been trained to do in this mentorship. So it wouldn't make a difference if it came back on you like this and stopped you out at your original entry, because you've paid the trader here, here, and here. And it's been a straight shot from London Open and overnight at midnight. So we're in a new session. So it's likely to do what? Move to a discount. So we could see it come back down to the old high, maybe sweep below it, but this here shows an aggressive move lower. So does that mean go in and start hunting this objective here again? Not yet. But you can find profitability with this model, small little movements, and buying around in here at the London Open, that's 10, 20, 30, 40, 50 plus pips in Australian dollar using this model, using previous day's high, weekly range expansions. Doesn't even need to go to the target that you would expect to see it trade to. Again, that's what I was referring to all the time. We do not try to predict the closing price of the weekly range. All we need is the direction where it can make a move one way or the other. We're deciding, okay? That's all it is. We're not predicting the absolute end of a weekly candle being higher or lower. We're anticipating and looking for evidence to support one side over the other. You're going to get it wrong. I get it wrong. But you can find setups and be technically incorrect, but fundamentally profitable. What matters more to you? If you're the young guy in here, you want to be right and rich. And I'm telling you, it's better just to be rich. Because being right all the time, it's not realistic. You can't be right all the time. I'm not right all the time. So if you can find setups that offer the movement you're looking for, and you can take out 30 to 50 pips, then you take them. And if it reverses on you after you've taken profits, who cares? Next trade, next setup. So this is one of those models that are very easy. You can be streamlined, systematically taken multiple times, throughout the week. There's again, a plethora of setups with this one. You can use the intra-week highs. You don't necessarily have to have just yesterday's high. You can use the highest high of the week or the lowest low of the week and anticipate a run if you're expecting the weekly range to expand in a specific direction. That weekly range expansion is like a filter. Okay, there are times where I'll take trades like this, and I may have started the week with an expectation that the weekly range may go higher, okay, and expand higher. But I'll take shorts in that. What do I do in that instance? I don't risk as much because it's going against my underlying bias. But because I'm flexible and I can work with intraday volatility, I don't need it to be only one side. And over time, you'll graduate into that understanding and prowess as well, but don't force it. Get good at picking one direction, operating in that one alone, profiting, and then moving to the sideline and conditioning yourself for that. Because if you do that over time, it'll give you longevity, it'll give you peace of mind. You won't be wrestling with the, well, I got to take another trade, or fear of missing something. These setups form, every single day, there's something to trade with this model. Every single trading day, this one appears. Whether it is a futures contract, a commodity, a bond market, an index future, it's there. I haven't looked at crypto, but I'd be interested to know if any of you are able to see this type of model form frequently in crypto. I don't look at crypto enough to know, but I would venture to say it probably forms a significant amount of time over the course of a month. And then dropping down into a 5-minute chart, you can see all of the business here. Really nice delivery, rebalance to the gap discount low here, and consequent encouragement of the higher time frame. Right in London Open, and you can see all the down close candles and gaps are being supported at price. And right before we leave the London Open kill zone, it starts to run. Then we have our typical 5 o'clock to 7 o'clock in the morning consolidation, and then it starts running right up into New York Open. Notice it does not come down into kind of retracement. It's just consolidation and run straight away. That is a straight line run, and they typically can set up your New York Open or New York Session market reversal profiles. Not all the time, but generally it can happen. And today, the 1st of June 2022, we had the dollar find some bullishness this morning, so it started to run up a little bit, causing all of this here. And I think that's going to be it for this one. Hopefully you found this one insightful. Until next time, be safe.